Thank you, everybody. Loving the conversations that are happening out there. I know it's tantalizing what's happening on stage. Love hearing the occasional whisper to your neighbors. Coming up next, we've got Roadmap for Institutional Capital Flow. That's going to be with Maja Vujinovic, the CEO of OGroup, Duncan Moir, president of 21 Shares, Ambre Soubiran, CEO of Kaiko, moderated by Elsa Backdahl, director of Pantera. Please help me welcoming to the stage with a big round of applause.
Hi, everyone. Thank you so much for your time, for being here today. Today, I'm thrilled to be sharing the stage with industry leaders who are at the forefront of driving institutional adoption of blockchain and crypto. During the panel, we'll discuss why institutions need to adopt blockchain, what's needed to get there. We'll talk about trends in institutional capital allocation, and we'll also share our outlook on the opportunities ahead. So Ambre and Duncan, you came from very institutional backgrounds and decided to take the leap to lead crypto institutions. Maja, you're an OG in this space. You saw an opportunity early on to help institutions adopt blockchain. I'd love for all of you to introduce yourselves, share what inspired you to get into crypto, and what you're doing currently to bridge the gap between institutions and crypto and blockchain. So, do you want to kick it off?
Yes, thank you very much. My name is Ambre Soubiran. I'm the CEO of Kaiko, and Kaiko is a market data and analytics company in blockchain and cryptocurrency. We've been around for about 10 years. We're a global company, and we work with financial institutions and mostly regulated crypto-native businesses for anything that has to do with crypto market data.
Amazing. Good afternoon, everyone. I'm Duncan, the president of 21 Shares. We're a crypto ETP provider based in Zurich. We service clients across 3 continents today. And I just want to say how nice it is to be on a kind of the odd one out on the panel, which is unusual.
On a funnel. Lucky man.
It's, I like that we've flipped the script a little bit. And look, what brought me into this world was really having worked in a large asset management company, seeing the inefficiencies that exist and the impact that blockchain can have on financial services. And I just had to get deeper into crypto.
Good afternoon. My name is Maja Vujinovic. I'll start the opposite. I went into crypto because I was living in Africa and Latin America in early 2000s doing mobile payments. I was a hacker, and I came across Bitcoin white paper, and I thought it was game changer, absolutely. So I've been in Bitcoin since 2010. 2013, I got into space properly by acquiring a first bank for Tether. And then later took a journey, as I say, I took a real job at General Electric. I was the youngest CIO. I ran all their machine learning and cyber and brought them first blockchain innovation. Currently, I run my own fund. We are fund of funds, but we also have an arm of OGroup where we help companies build and exit.
Ambre, why do institutions need to adopt blockchain, and what's the infrastructure that's needed to get there?
Yep, so I'll approach the question from the data angle, and data is a core component of market infrastructure. I would say we've seen the first kind of past 10 years of the industry with institutions looking at crypto as a new investable asset class. So the idea here is to say, okay, you know, this is going to become an institutional investable asset class, and financial investors are going to require market data that is on par to what they have for other traditional asset classes. And I think we're now getting to the inflection point where financial institutions are looking not just as crypto, as in we can invest in the asset, but rather as, oh, actually, this is a fascinating technology that we can use. And we're really getting into, with everything around, obviously, payments, stablecoin, tokenization, leveraging blockchain as an underlying infrastructure layer to bring operational efficiencies in the way existing financial services work. And I think that this is the interesting evolution, a bit kind of graduating from pure crypto and moving into using the underlying technology. And what we've seen with the DeFi is that it proves that the technology works to enable financial services. And if you believe in that, if you believe that financial institutions are going to rely on blockchain-enabled kind of workflows, then the importance of data and the reliability of your data provider becomes critical because you're in an increasingly disintermediated setup where the data that you input is going to trigger execution across the entire value chain and becomes even more critical.
What's a typical, if you have an example of a firm that you worked with, where did they start? You talked about DeFi, stablecoins, financial products. What's the journey like?
So for us, most of what we service today is still institutions looking at crypto as an asset class, right? So they need to understand market data, market dynamics, market microstructure, liquidity risk, everything that has to do with trading the asset class. And then there's all the use cases, and probably Duncan is going to talk about it, but whenever you start building financial products on the asset class, you need a level of reliability and accuracy for your data that is becoming really important. And so Kaiko is regulated under a regulatory framework that regulates how data providers can issue benchmarks and indices in the context of then building financial products on top of it. So as soon as you start layering a financial application on top of data, the data becomes more critical. And this is typically something we're working on with 21 Shares, where Kaiko provides underlying benchmark rates and indices to ETPs that are then created and distributed by 21 Shares.
Would you say there's any sort of key challenges that these institutions and companies face when they're transitioning into offering these crypto products?
I guess definitely there's going to be a lot of regulatory constraints on the issuer side, something you can probably touch upon as well. But in financial institutions and mostly banks have stayed relatively clear from crypto until recently. And the latest developments, especially in the US, have alleviated a little bit of that weight on the institutional side.
Yeah, we'll talk more about that. Maja, you've spent over a decade helping large companies like General Electric get into crypto. For any institutions in the room today, what would be your advice to adopt the technology? Where do they start? And also, what's the biggest opportunity, if there is one, that's blockchain related that these companies can capitalize on today?
Yeah, I think it's all right. Depends on the interest and depends where you are in the world. I would say, if you look at Middle East, it's a lot more ready to adopt technology like this because there are no legacy systems and there's not a large quantity of middlemen, right, in between. So you can make a decision and just go, and not just with blockchain, but a combination of blockchain and AI. But if you look at IoT also, most people, because we always talk about finance, right? But on the IoT side, I mean, it's a perfect use case for a lot of people. We did it in 2016. And so you can use smart contracts and machine learning to get data off the edge of an asset versus take the data and pull it into the centralized pool and then distribute it to customers or have business models from the customers. Right now with AI, you're going to be able to have the business model. It's going to what I call a MaaS, right? Model as a service versus SaaS. And so that's something that companies usually don't think about because the first example is FX or trade finance or things that are relatively easy and easily digestible. Because blockchain really a lot of times requires you to completely think differently from your infrastructure. So it's a mental shift. And I think it's very hard, not just maybe regulatory. I think we all talk about regulatory or security, but there's something that comes before that, which is human nature and culture. And that's extremely hard to change when you are doing this. And so I think a lot of people are doing, I would say Middle East is much easier because there's no infrastructure, as I said. I think in other places in Europe, we've got challenges, as both of these folks know better than I do, which is with data. So it's very hard for institutions to move much further and innovate. But I think we're getting there much faster, actually, than what I thought, because it's extremely hard. And I think if you haven't had any experience in a corporate world, you don't realize how hard it is to move a massive ship into another direction. And sometimes it requires you to pause an existing IT system in order to launch something else. And that's very hard when you have thousands and millions of customers that rely on you. So.
Yeah, so it sounds like it's not only hard on the tech front, but if the culture isn't there, you're not going to get there.
Exactly. Well, the culture eats tech for lunch, as they say, right?
Yeah. So how can you influence culture? There's so many companies that have big institutions that are traditional, that have a blockchain team, but then people in that team, and I've seen this so much, they get frustrated because crypto is not sort of the North Star of that company, and so they leave the firm. So how do you advance that culture?
So I'm gonna be a little controversial. I was told not to, but so not everybody needs crypto or blockchain. That's another thing. And so I think a lot of people, I think it's a lot of younger people who will push for this. But reality is, we've got really good data sets and databases that function better than clunky blockchain. Blockchain is extremely clunky. So anybody here, and I see a lot of people who are executives in this room will agree, even though you're innovators and you want new technology, it's extremely expensive and it's clunky and you really don't need it. And by the way, there's another part. It's sometimes not in your interest to have a blockchain. Doesn't matter of the privacy, it's not in your interest because everything is almost transparent. Yes, you can argue privacy and ZK and everything has its role, but it's public. I don't want my stuff completely public. So I do think that if I was a CEO of AXA Insurance or of any large company, I would think twice if I want this or not. Now, is that going to make me less competitive than somebody else? Perhaps, right? If you look at banks and the traditional banks and you look at neobanks and wealth tech platforms are really taking the large chunks of business of these banks. So do they have to compete? Yes, they do. But do they actually need the block or must have a blockchain? I'm not sure about that. So I might be on a minority of this room, but I've also seen it in practice. And so I'm not sure that we should be pushing people to use it if they don't need it.
Yeah, I love that perspective, and I think it's right. I mean, so I spend most of my days, actually all my days, speaking with institutions, and we've heard so much about stable coins and how it's such a no-brainer for banks to adopt stable coins. Actually, it's quite a big capex. It costs a lot of money, and not all of them want to adopt it for those reasons. And it's not the technology, it's not the culture, it's just, it doesn't really make sense. So I like your controversial perspective. Duncan, moving on to institutional capital allocation, what trends are you seeing in institutional capital flows in exchange traded products at 21 Shares?
Sure. Actually, can I just one point on?
Yeah, please. We need to.
Because the dagger to my heart.
My style, a little controversial. Yes.
We probably technically don't need blockchain for anything that we want to do, but we seem incapable as humans of building infrastructure that is actually interoperable. So the one thing that blockchain brings is standardization. We seem to love to build things in silos, especially at big corporates. So that's my kind of argument against the point.
I do agree with you in that, and there is a part of that standardization that makes things more seamless and easier. I just think they're still clunky for a mass adoption in these systems. That's all. Yeah. Fair.
Sorry. So on institutional trends, I mean, so at 21 Shares, in about half of our assets are in Europe. So we've got about $5 billion in Europe today. Half of that is institutional money. So we've got that, and that part of the pie is definitely growing. We've got institutional clients that have been with us for many years. They are amongst the most sophisticated investors in the world, we believe. But we also have institutional investors who are brand new, right? They're crypto curious, so they are the ones that are going into BTC as their first investment, and more of that is coming in. So we see the private banks, for example, in Switzerland in particular, moving from an execution-only model to an advisory and a discretionary allocations to crypto. That will be a big change. We see wealth managers in Spain and in Italy come on board. German pension funds now starting to allocate. Even in the UK, which is so far been almost non-existent as it relates to crypto, we saw the first defined benefit pension fund allocate directly to Bitcoin. So it is really coming. And I would say the other thing that's changing is almost how they're allocating, how they're thinking about allocating. Most people buy into, either they buy into Bitcoin, they just see it as a tradable asset, or they buy into the whole store of value concept. But now we hear them talk much more about the altcoins and what is the investment thesis, where does this sit in my portfolio? They want to understand the use cases. So all the discussions around digital identity and tokenization, they have a real, even though we might not see the activity, have seen the activity we want to with those use cases, they have real relevance for the investors who are looking at the tokens.
I saw you launched a product on Dogecoin. How does that narrative resonate with the institutional investor? Yeah.
Look, I mean,
the pension funds ask for it. Right?
Yeah, look, no is the answer. But the thing about Dogecoin is it's a story that nobody gets yet. So to everybody here, it's probably a meme coin or a joke maybe. But it's the reality is that Dogecoin has an amazing community, has a massive following. I mean, talk about product market fit. They nailed it from the go. Okay, so they got this huge community of active users of Doge. And now the foundation is pivoting towards payments. So now we're going to start to see applications built on top of Dogecoin. And you already have a captive user base there. That's something that most of the other chains do not have. They've been trying to push their agenda from when they started, which might be around gaming, it might be around DeFi, it might be around enterprise adoption, and it's a hard slog, right? You've got to win these, bring these customers in. Dogecoin today may not be the institutional story, but it will be in the future.
Do you have any institutional investors in that product?
Oh yeah, I mean we have institutional investors that are traders that will trade the product for sure.
I do think, if I may, even Amber and I have known each other for a very long time, 10 plus years in the space, and that's a really powerful, most people now will look at community and will say, oh, shit coins and meme coins and whatever, right? Because it has gotten to that rep, it has that rep. But the power of that community, really, if it's done correctly, it really what will drive the value, and then you can reverse it by them building a use case. Because most people will say build a use case and then everything will come. But if you build a community in the right way for long term, which its founders, we've been holders of Dogecoin from beginning, and I've never let go. But because I like the founders, I like the sentiment.
It's more efficient to hold it as an ETP, by the way.
Okay, all right, well, good to know. But I think that community, even early days, that community is what drew all of us together, because we were in there for a long term and we stuck together as a community, right? So I do think it's, most people now, because we're going so institutional, people forget that this is still community driven. Crypto is still very much community driven. I think it's important.
And I think for institutions, they're very receptive to the payments angle, right? Which is the obvious kind of low hanging fruits with crypto. And indeed, if you have the network that is already built, then you just bring on the payment system and then it works. Yeah.
So maybe to continue on that, do you have any expectations or any outlook on what the institutional crypto allocation bucket will look like in the next, say, 24 months?
Do you want a prediction on the size? I mean, look, I can't say 24 months. What I'll say is the asset management, the investment management industry globally is about $100 trillion. Okay, so let's take a conservative 2% allocation. there's $2 trillion more to play for just from that bucket alone. That's the market. That's the addressable market we're going for.
And what type of products do you think that they'll invest in? I mean, now it sounds like Doge, all these others. So it's not just Bitcoin and ETH anymore.
No, it's not. But I think, look, this is going to. I mean, for the wealth managers, for the asset managers, I think basket products will be the one that they go to. Look, I think this is going to evolve much in the way that the traditional equity ETF industry did. So you've got your basket products, which are like the top 20 or the top 50 or whatever, and then probably you have your sector or use case products. You have your payments, basket of payment tokens, basket of tokenization tokens. I think that's probably the way it will go in the future.
I think I really like if I can, I really love ETFs and ETPs because I think they're going to be an incredible, important part of growing liquidity in crypto. And sometimes people take the problem a little bit upside down, saying, oh, we cannot build an ETF on that product because it doesn't have enough liquidity. And I think there's a balance. It's kind of which is it the chicken or the egg, right? Is it the crypto needs to be liquid enough in order to build an ETP or an ETF on top of it? Or actually, the second you start having an investable kind of, financial product that is synthetically representing the the financial exposure of the underlying, people will need to replicate that price and will actually bring liquidity. So it's a bit of a self-fulfilling prophecy
100%.
To say that if you launch ETPs and ETFs on more crypto assets, you're actually going to support liquidity being brought to the space and thereby bring liquidity that enables more.
Yeah. I mean, if we launch a product, we need a traditional securities exchange to sign off on the token. So there's some sort of kind of verification and credibility that comes to that token. We need a custodian or multiple custodians to support it. We need crypto exchanges to support it for liquidity. We need liquidity providers, index providers, the whole range. And just launching a product, in some cases, will force the support of that project with these infrastructure providers.
Duncan and Ambre, your firms started in Europe and have now grown a very big presence in the US. Since the US election and the coming regulation, how have your conversations with clients changed on both sides of the Atlantic? And then is there an area where Europe is in the lead?
So from a data perspective, the US has always been our biggest market. I mean, we've always had more than 50% of our revenue stemming from the US market, just because they were early on into crypto and investing, and also there's a bit more appetite, I think, and ability to spend for market data because it's just part of the way business is done there. I think when it comes to ETFs and ETPs, it's really interesting because in Europe we had the first ETP traded on the Stockholm Nasdaq, I think, in 2014.
I used to work there.
Yeah, by CoinShares, right? And we used to be a data provider.
It was listed on the Swedish Stock Exchange. And I'm Swedish, so
yeah.
that was a quick job interview.
So Europe was super early on when it came to kind of having crypto. It was a Bitcoin ETP in 2014, and then there was a ETH ETP shortly after. Super visionary, super early. CoinShares was really kind of very early on that front. XBT provider, I think, at the time. And but the AUMs were small. I mean, relatively to what it is today in the US. So then we've seen a flurry of ETPs. I'll let Duncan talk about that. It's more his thing. But what we're seeing now is that now that for a year and a half, the US approved ETFs. Obviously, we're seeing a lot of the volume and the demand now being driven by the US ETF. And I don't know what's the lesson to be learned here for Europe, which is like, we tend to innovate first, and then we regulate so much, and we don't have as much kind of spending power and capital than you have in the US. And then the US comes in later and, kind of kills the show a little bit.
Yeah. I think we did enough to get things out the gate in Europe, but then when it came to the true institutional adoption, I mean, just very simply, only, what was it, last week or was it Monday? The FCA in the UK announced that they expect to lift the ban for retail investors to invest in crypto ETPs. way behind the rest of Europe. In Europe, crypto is still not eligible for UCITS funds. I mean, you are not going to get European asset managers putting crypto into their products if they can't sell it to retail. So there's these things that need to change, and I think the US can really catch up quickly on Europe. I think the US is going to go much in the same direction in terms of number of products. So we'll probably already have about 10 different list filings in the US across different tokens, including basket products. And the US has pretty good wealth kind of set up and distribution of ETFs and ETPs. It could be an amazing opportunity. Yeah, we're very excited.
Okay, so it sounds like maybe the opportunity for the European firms is to be bought by the US firms.
Oh, we don't need to be bought. We've got our own presence. I should say we also have an amazing partner in the US, which is ARK Invest, Kathy Wood's firm, and that's, I mean, sorry, I was just saying that's largely the driver of us having the third largest Bitcoin product in the US.
I don't think the goal here for European firms is to necessarily get acquired by American firms, but definitely to address and tap into the American capital and kind of spending power. Yeah. And for that, I mean, you need to be very much boots on the ground, and it is not easy for European firms to be perceived in the US on par to local businesses, even if you actually, have been on the ground since quite a while.
Yeah, I mean our largest office is now our New York office, so it's bigger than Zurich.
Yeah, same for us.
Yeah, I know you spend a lot of time between Europe and the US. So, Maja, maybe changing the conversation a little bit. 8 years ago, in 2017, you predicted that stablecoins would be the killer app for institutional adoption. Has it played out the way that you expected? And what do you think we'll be talking about in 8 years from now?
Yeah, 2017 is also when we built so-called AI agents on devices on the edge. They were not called AI agents, they were called different things. But yeah, it was, we did see it, and I think partly because I spent 10 years in Latin America and Africa seeing the challenges of payments, and to me it made more sense because Bitcoin, to me, wasn't at the time ready to be used. And I think whoever was here earlier, Elizabeth, was talking about that too. Now I think it's really could be prime time. Have stablecoins played out in the way that they should? I don't know what that should is. But I definitely thought stablecoins were going to be a lot more used by retail versus by traders, because really majority of volume is with traders at the moment. And I would have hoped that the stablecoins would have made their way much faster across markets where it's actually needed, which is emerging markets. Right? I saw the real use cases in places where you wake up one day and you buy this table for $10, the next day it was $10,000, right? And it's insane. And so I think those are real use cases. It's what I call God's work for some of these families. And so we don't really feel it in the West. You have your Apple Pay, you have your credit card, you don't really care. I do think that we are going to see a lot more stable coins as more assets come on chain. It's just going to make sense for them to come. Market in Europe at the moment, I think, is a little oversaturated. There is a lot of issuance of stable coins without real kind of use cases, so I would love to kind of see that proliferate. But I do think it's a very interesting space, and I think the prime time is now. It wasn't last 10 years.
Yeah, with the Circle IPO, which seems amazing. So any predictions on what we will be talking about in 8 years, since we were so ahead of the curve?
This was not on the list of your questions. I think 8-10 years from now, probably, I mean, AI is everywhere. I think crypto is going to be in the background. ZK is already in the background. Blockchain is in the background already for cyber. It's been in there for a while, since 90s, right? Blockchain is not something new. I think AI agents are really interesting. Also, I spent some time with Elizabeth earlier, and we've talked about what they're developing on AI agents and Bitcoin. I think it's fascinating what's going to happen in that space in terms of our ability to interact. We're all going to probably have a couple of agents in the next 8 to 10 years. We really will. I do think the next 2 to 3 years are really critical. What I think is really interesting for this industry that not a lot of people talk about, and actually is quantum. I know that there's a back and forth on quantum. Is it going to disrupt Bitcoin or not? I do think that in next year, and I predict that publicly, that Google or one of these guys is going to come up with something that is going to nudge this industry a little bit. And we may start to see forks on Bitcoin. And I do think that's an interesting space to watch out for and really learn about. So, and I wouldn't be surprised if even the US government attempted a fork of Bitcoin. So,
Thank you for that. I think we have a couple of minutes for questions, but before we open up for questions, I wanted to give you all the opportunity to ask another panelist a question.
It's not a question, but I love that you brought up IoT and AI. I think if you think about all of the it ties back into payments, like micro payments of connected devices that needs to pay each other, even if it's just like fractional moments where they have to use electricity or whatever. I think the IoT angle is extremely, extremely interesting, combined with obviously AI, because there's too many small things to justify having a human or to even enable having a human. So the combination of AI and IoT needs a payment rail, and it can only be crypto, because it needs to be programmatic, it needs to be binary, and it needs to be trustless. And so if you believe in AI, it's so funny, at some point there was a bit of a shift where investors kind of away from crypto and went full force into AI. And I'm like, if you have a thesis on AI, you have to believe in crypto, because this is the obvious payment rail for any kind of AI-enabled workflows. You will need to have this payment rail, and it can only be crypto because it's programmatic. So I love that you brought back that into the conversation.
All right, I'll give you time to think up a question. Mine's for Ambre. So as more institutional money comes into the space, into crypto ETPs, our fees are going to have to come down, right? Not everybody's going to be happy paying the higher fees, which means our margins are going to be compressed. As one of our valued service providers, how are you going to respond to our margins?
I cannot believe you're negotiating the next
publicly, and I'm a lawyer,
next data license on stage.
You're not our lawyer, though,
I'm Ambre's lawyer. So.
I mean, negotiation, 205 or something, very advanced. No, listen. I mean, what we hope is that fees go down and volumes go up. Right? I think that's the name of the game. I think it's the interest of everybody to have AUMs increase significantly, and back in the days when the first ETPs were launched, we had percentage of fees that was multiple percents, because that was giving exposure to a very exotic asset class back then, and that justified having so much margin. Today, the fact that margins are so much lower, and we're talking sometimes 5 bips over, Bitcoin ETFs. It's so slow, so little, but it also is a very strong kind of KPI of how mainstream Bitcoin has become. So it's in our interest, I think, to see that the efficiency of that industry, and the efficiency and the ability to distribute. I mean, the lower the fees, also the better you can sell and distribute to the wider audience. So we'll take the lower license fees if it means more business, more volume, more crypto.
Good to know. Thank you.
Okay, question for Ambre. Are you going to see a lot of M&A in data?
It's something we've discussed in the past, so yes. Clearly, I think, just crypto, by the way, not just data. Data is my gig, so I'm very much looking into these things. But I think crypto has benefited over the past 10 years from a lot of kind of tailwinds, even though we went through some horrible bear markets, even though it's been not always easy, prices have been up and down. Overall, most crypto companies have been able to raise either because they did massive ICOs and they've kept crypto, and so you have companies today that have been around for 10 years that have still huge treasury in crypto, and that I think is an interesting financial profile for startups, because that's kind of unseen. So forget for a second the ones that did ICOs. We also have all of the more traditional VC-backed data companies that followed the traditional, typical seed, Series A, Series B VC model, and where growth was a priority over healthy profit margins and kind of building pricing structures that was in order to build a profitable business. And I think we're in a space today where the industry has matured. Every company in that VC model has reached Series B-ish level for those that have survived long enough. And now we're seeing a lot more focus getting into growth stage, Series C and above, on more kind of profitability and healthy financial KPIs that most companies don't have. And the crypto industry is and here data specifically, extremely fragmented. And I don't know of a lot of profitable data companies in crypto. So I think it will go through some consolidation, and that this will be a very exciting opportunity for the industry to have a couple of leading companies emerge and be there for the next 20 years. And hopefully we're one of them.
Thank you. Are there any questions in the audience? No questions? Okay, well, thank you so much. It was a pleasure sharing this stage with you. Thank you all for listening, and come chat with us if you had any questions you didn't dare to ask.
Thank you.
Thank you.